Okay, let's get started now. How should you simulate your strategy? You could use a screen, you could use the screen's rolling backtest, or you could use a simulation. I would advise you to use the screen backtest if you plan to rebalance to equal weight every period and your periods are 4 weeks or less. The screen backtest is a really powerful tool, and it's sufficient for most rudimentary backtests. And one of the great advantages of using the screen is that it's simple. It's not very complicated, and it can tell you if your ranking system is solid or not. Testing a ranking system using a screen on various universes and time periods is a great way of seeing whether it's suitable for the next step before you go to the trouble of creating a simulation. Many people just jump right into the simulations and don't bother using screens and rolling screen backtests, and I would advise everyone to do that first. Use the rolling screen backtest if your holding period is fixed at more than 4 weeks and you plan to rebalance to equal weight. The rolling screen is better for backtesting strategies with long holding periods than any of our other tools. Really, it's even better than the simulation. If you're planning to have holding periods of 12 to 18 months, a rolling screen backtest is really optimal. So I'm gonna show you a little bit how that works. Here's I'll open a new screen, and damn it, I think I have to shut down Teams here. And if you're, so I'm going to open a new screen here, and let's just use the no over-the-counter universe. And I'm going to test a ranking system that I designed recently. Scrap essentials, and we'll have 20, let's say maybe, how about 40 stocks? And let's say no rules. We'll just backtest the screen. Maybe choose, and these Zoom windows, 10 years and 20.25% slippage. Seems good, and we can run a back test like that. Now, this will show us how this ranking system worked on the no over-the-counter universe, and then we can test it on other universes, and you'll see that the tested pretty well, 61.29% per year, just kind of out of this world. You'll never get this in real life. And if we change the universe to, the Zoom windows get in the way, to the Russell 2000, we can run the back test again and see how that goes. And the annualized return goes down to a more realistic 30%. So that's a pretty simple thing. Now, let's say I wanted to use a holding period. Instead of every 4 weeks, I wanted to use a holding period of 6 months. I could run this same back test with the frequency of every week or every 4 weeks over the last 10 years. And it would give me a very different kind of result. It gives me, instead of a chart, an equity curve, it just gives me a list of what the what happened each week. And this excess return column is what I always look at first. And I can see that most of the time it did pretty well, but sometimes it didn't. If you scroll down to the bottom, there are these nice things where you can see that during most periods, well, the average is 12.15% per 6-month period, which is very high. It's much higher than the benchmark. But during down markets, it really performed poorly. So this could be this could be improved. Let me just go back to the regular backtest. I want to show you something else that you can do with screens, which many people don't know about. When we ran this backtest here, I'm just going to show you something. You scroll down here and you get the number of positions, new positions, sold positions, and the turnover. If you go down to the bottom, you get the average. The average here, the average turnover is 42%. So I'm selling 42% of my holdings every 4 weeks, which is a lot. But what we can do here with the screen is add rank tolerance. So let's add 5% rank tolerance. What that means is that if you buy a position and its rank is 98, you won't sell it until its rank goes down to 93. You'll just keep it. And if its rank is 94, you won't sell it till its rank is down to 89. And so this you rerun the back test and you can see, does the return get a lot worse? No, it doesn't. It only goes down by 1%, but the turnover went down to 19%. So that means your ranking system is really nice and tolerant, and it's another good way to test just using the screen rather than going to the more complicated simulations. Okay, we're going back to the PowerPoint now. Use this simulation if you want your holding periods to vary depending on the stock. For example, if a stock ranks highly, you might not want to sell it or rebalance to equal weight, but just let it run. I mean, if you've got a stock that has gone up 50% in price, if you use the screen, it'll rebalance to equal weight after 4 weeks. But if you use the simulation, it'll keep it at that 50%, at that large weight, unless you don't want it to. I'll talk about those settings later. If you want to vary the weights of your holdings, for example, you might want to hold more of stocks that are ranked number 1 than of stocks that are ranked number 42. You want to use buy and sell rules that are more complicated than the screen or the universe rules, or if you want more detailed statistics and charts for the results. Those are all situations where you want to use the simulation. I've got 9 ways that simulations can really help with refining your systems. You can test increasing or reducing turnover, test increasing or reducing your holding period, test the effects of varying the weights in your portfolio, and I'll be showing you how to do all of this stuff. Test the effects of hedging, test the effects of slippage, look at performance by year and month, look at drawdowns, look at trading statistics, and examine your transactions. That last one's really important. And I'll be going over how to do that. So when you start a simulation, the first thing you're going to see is the General tab. And I'll show you what that looks like. Just leave this. So the General tab looks something like this. Now, the starting capital, you may think it doesn't really matter because all you're looking for really is your percentage returns and your alpha and your Sharpe ratio and all that stuff. And it's going to be the same no matter what starting capital you have, right? But that's actually not true. If you start with too little money and you have a lot of positions, then some of the high-priced stocks are going to be unable to be bought, or you're going to have weird amounts. Because we don't do fractional shares here. And on the other hand, if you start too big, if you're running a simulation that's going to get 80% annualized returns over 20 years, then this is just, you're going to end up with figures that are off the charts, and your simulation might actually end because you've reached $1 trillion. So you want to be careful about your starting capital. For the benchmark, I would always choose a benchmark that's really relevant and correlates well to the kinds of stocks you're choosing. Slippage can be variable or fixed. The fixed slippage is very convenient if you know pretty much what you're going to be paying in slippage. Variable slippage has extremely different slippage levels depending on whether you are buying a stock with very low liquidity or very high liquidity. And it's based on the daily dollar volume of the stock. And it's pretty high. I mean, if you're buying a stock with a daily dollar volume under $50,000, it will charge you something like 5%. So just be careful with that, but it is a really good thing to run your simulations with variables slippage at the beginning when you're testing them out, because it's kind of a worst case scenario. And it'll really make you careful about showing outsized returns on stocks that are basically unbuyable. And then the transaction type, I'm not going to go into short simulations today. It's more of an advanced tool. Use margin. I use margin. So simulations, will help you model that. So I put in my settings here. Price for transactions is a really, really important field. I would never use previous close, and I would never use next open. I always use next average of high and low or next close. Previous close and next open are just unrealistic. Nobody actually will get those prices. Those are just too good. And transaction save, I almost always use yes. And the only time I check no is if I'm running a strategy with 100 or 200 positions and I'm doing a lot of rebalancing. It's very, very useful to be able to look at your transactions. Now, percent portfolio weight settings. This is the next tab on our simulation. So portfolio weight, and this is just our default. You can put in 5 here for 20 positions, or 10 for 10 positions, or 3.33 for 30 positions, whatever number you want. And rebalance frequency is pretty clear. If you're rebalancing less frequently than every 4 weeks, you should probably later run a rolling back test of the simulation, and I'll get to how to do that later. I always allow immediate buyback if I have buy rules and sell rules that can conceivably apply to the same stock. Also, if you want to if you want your simulation to act just like a screen and just simply sell everything and buy it back, obviously you want to use that button. The buy constraint shows you, if you've got a very, very high price stock, this is kind of useful. If you've got a lot of dividends that you might want to reinvest, this buy constraint is useful. If you set it at 10%, it might be too restrictive. I think 30% is a good default to use. Now, I use formula weight myself. And these are the settings that I've found optimal. Formula weight is quite difficult and can present a lot of problems. You'll get transactions that are very lumpy. You'll find yourself that in one rebalance period, you'll buy a top-ranked stock, at one, maybe like at 10% of your portfolio. And the next rebalance, you'll buy the top-ranked stock at 3% of your portfolio, just because that's how much cash you have available, and you haven't gotten the settings altogether right. So also the other problem that you can run into with formula weight is that you might get lots and lots of tiny little rebalances that don't really make any difference. So in order to avoid those, I have fiddled over the years with the formula weight settings a great deal, and these are the ones that I have found optimal. I'll go through them one by one, but I'll just let you know that the Oh wait, I've got someone in the waiting room here. Okay, I'll let you know that this is, you know, this is kind of rough, and um, you can fiddle with it a lot. You can make a lot of changes and experiment with it and see how it works. Um, so here is my formula weight settings. The ideal number of positions, I usually have it really high because I like the flexibility. I would set this to the maximum number you conceivably will hold, or even more. It's just much more flexible. With formula weight rebalancing, sometimes you want to have varying numbers of positions. If you want to always have a certain number of positions with no exceptions, then I would set this to that number. But if you're willing to be flexible, which I think has some advantages, then I would set it quite high. Reconstitution and rebalance frequency, I would keep those the same period. It's a little confusing if you have one be 4 weeks and one be every week. Allow immediate buyback. That's really up to you. I went over the pros. That it really depends on your buy and sell rules. I have buy rules and sell rules that are totally exclusive, so I just put no. Maximum portfolio drift, I usually put about 10%. What this does is it means that if all the position changes add up to only like 8% of your portfolio, it's not going to do anything. Which is fine. Position weight formula, and I'll talk about position weight formula next, but I'm not going to talk about it right now. Illegal formula values, I always do skip or sell because sometimes your formula value will end up with -1, which means you don't want the stock. Now, sometimes your formula, if you'll never get a negative number in your formula values, then you could put trigger error just to see what else might happen. But if your formula value might have an NA or something in it, it just stops your simulation. The weight constraints, minimum weight 1%. That means I'm not going to be buying stocks that are less than 0.5, that are less than 1% of my portfolio. Maximum, I'm putting at 40% here. You can go up to 100%. You can go down to 5%. What these do is that they look at the range of possible weights and they scale accordingly. So if you want to make sure your positions don't exceed a certain percentage of your portfolio, you should definitely set this at that percentage. But if you don't care, leave it high. And here's something to watch out for. If you have, say, 20 positions and you set your maximum weight at 5%, you're going to have a lot of cash because you have variable weight, but the maximum is going to be 5. And so if you have one stock that has a formula weight that's much, much higher than the others, you're going to have a lot of cash in there. Maximum position drift is, I usually set it at 33%. So that means basically, if I have a position that is, has about 5% of my portfolio, and the formula weight says it should be 4%, it's not going to do anything because that's 33% of 5 is not 1, is greater than 1. So that's I think 33% is a good number to use there. Minimum rebalance transaction, again 1%, so that if a transaction looks like it was going to sell 0.5% of my portfolio, I'm not going to consider it. And now there's the exposure after rebalance. Allow deviation up to 100% from target leverage. This is essential to keep the weights of new buys and steady each rebalance period. But it has a disadvantage. It will give your strategy some overall leverage, around 5 or 10%. And so it's going to inflate your returns by 5 or 10%. It's just important to in order to keep your buys and sells from varying hugely from week to week. Now, position weight formulas can reflect rank, can reflect liquidity, or can do both at once. So I'm just going to go to an Excel file and show you. So here's an Excel file with some rank positions, and I'm going to use, let me use the first formula, the second formula here, 50 minus rank pos. I'll just show you how that works. 3, I'll copy this down. So this is what the formula is going to give. And so what is the actual position is going to look like? And we'll copy this down. And this is what the actual positions are going to look like if you use a formula like 50 minus rank pos. And you can see how that works. It's very simple arithmetic. Now, there's some more complicated ones. Like here's one. The second one that as an example is 1 divided by the rank position minus, so rank position, sorry, plus 5. Whoops. Forgot the dividing sign. Oh, come on. All right. So now you can see it's a slightly different results. You know, you've got a bit of a steeper curve. There's a big difference between position number 1 and position number 2 here. So I like to have that steep curve. I like to have the number 1 position be a lot more than the rest. But you know, that's my personal preference. But that's one formula I came up with to do that. Then this is the one I usually use. The next one is the logarithm of 50 minus the logarithm of the rank position. And this will give me numbers like this. Again, this is even steeper a curve. This is the kind of thing that you can play with endlessly. And I've given you some other examples. There's also liquidity. There are also liquidity formulas that here are, that are here on this PowerPoint slide. So, you know, for example, max 100 market cap will say that anything with a market cap of 100,000 or more will have a certain amount. But if a market cap is only 30, it's going to have only 30% of that amount. Now, the position weight formulas don't have to add up to anything. They can add up to, you know, all the different possibilities could add up to whatever, you know, they're all scaled each rebalance period. So you don't really have to worry about making your position weight formulas always cap to 1 or always max at 100 or anything like that. And if anyone has any questions, please do chat. The next tab is the universe and ranking tab. And I would suggest that you always choose a universe, that you do not go with all fundamentals. Force positions into universe is a really handy thing. So let's say your universe is the Russell 2000. And one of your stocks gets really big, increases in market cap, and it ends up being in the Russell 1000. Well, you don't want to sell it just because it went into the Russell 1000. You might want to hold on to it. So you force positions into universe. I always use yes. And the only exception is if you have some universe rules that are really prohibitive, like no matter what, I do not want this stock, then you might want to choose no. The next tab is the buy rules. It's best to put most buy rules into the universe rather than into the simulation. For example, if you use rank position in your sell rules, but you exclude illiquid stocks in your buy rules, you'll have some weird numbers for rank position, right? Because the stocks ranked number 2 through 5 might not even be eligible. You can leave the buy rules blank if you have good sell rules. Your simulation is just going to buy the top ranked stocks when it has cash available. You don't have to put anything in the buy rules if you don't want. I like using a buy rule like rank position is less or equal to 10, along with formula weight rebalancing. And the rules that are end count, end weight, security count, sector count, sec weight, subsector count, and so on, those are really good buy rules to prevent your strategy from being too heavily weighted in one particular group of stocks, unless that's what you want. And I would definitely familiarize yourself with the options in this folder here, strategy. I would go through each one of these and read about them. There's so many really cool things that you can do and rules that you can play with. And I'm always discovering new rules, new toys to play with in the simulation using these strategy rules. Sell rules. If you're using formula weight rebalancing and some of your stocks will get 0 weight because of ranking, you can skip using sell rules. And I mean, if you're using any of those formulas that I showed you before, any stocks that have rank positions greater than 50 are going to end up with 0 weight, and you don't even need to put any sell rule at all. Otherwise, I would suggest using rank position is greater than a certain number. And remember that sell rules are by default or rules. So use and for exceptions. So for example, rank position is greater than 50 and stale statement equals 0 and number of days is greater than 20. That's going to sell stocks that are not ranked in the top 50, but it's not going to sell them if they have a stale statement, and it's not going to sell them if they've been held fewer than 3 weeks. So this is a great rule for me because I don't want to hold a stock for just 1 week. And even if it's ranked really badly, I don't want to sell it. Unfortunately, I cannot yet, until we modify the way simulations are run, cannot yet do this kind of thing with formula weight. The no days is greater than 20, but maybe in the future. Now, there's a little known rule that allows you to sell a portion of your position if it's too big. And that is eval weight is greater than something, and then a fraction, and then 0. And that means that if the weight of the position is greater than this percent that you want, sell half of it, and if not, do nothing. I have a question here. What is a stale statement? A stale statement means that the company has made an announcement and the data provider, in most cases it's going to be FactSet, has not yet processed it. That usually is taken care of overnight, or sometimes 2 days, sometimes 3 days with an extremely low liquidity stock or a foreign stock. It might take a week. If you're using CompuStat, it could be up to 4 weeks. But that's a period when I like to sell and buy nothing, because I don't know what the data is. The data has been supplanted with a recent announcement from the company, but I don't have it ranked. And for a simulation that replicates a screen, some people have been doing this lately. They've been trying to replicate a screen with a simulation. Just use 1 in the sell rules and allow immediate buyback in the rebalance tab. And once again, take a look at that strategy folder in the factor and function reference. Oops. Now, the hedging and market timing tab is pretty flexible, and it's pretty easy to use. I don't use hedging or market timing myself. I'm a much more traditional value investor, no market timing. But if I did, I might hedge by putting a constant percentage of my portfolio into an ETF that's uncorrelated with the market. Or I might employ a market timing hedge like this one. This is the kind of rule that you can write if you're hedging. So let me just unpack this for you. This says that if the unemployment rate is greater than its 12-month moving average, close zero unemployment is greater than SMA 12, zero unemployment. And if that was true last month as well, close one unemployment is greater than SMA 12, one unemployment. And the S&P 500 closed under its 10-month simple moving average, then go to hedge. And then the exit rule could be the S&P 500 has gone 2.5% over its simple moving average. That's a pretty basic kind of market timing rule that a guy philosophical economics came up with. And it would have completely failed in 2020. And but that's the way market timing is sometimes. Now, period and restrictions. And this is, I have showed you this is the hedge here. Enable gives you all these options. And then the period and restrictions is here. A few things to note. I usually test 10 years, but feel free to go back further, 12, 20, 30. Well, you can't do 30, but 22. I suggest not testing much under 10 years because you're going to have some really weird results if you're trying to test whether a strategy is going to work long term. But I often just test the last 3 years for just to take a look at things like at turnover and slippage and things like that. The other parameters here are useful if you want to exclude specific stocks. And one reason to exclude specific stocks is if you look at the transactions tab after you run the simulation and you see that a huge amount of your return is caused by very specific stocks. You might want to exclude those in your next simulation to see if your ranking system still works without those stocks. I usually allow mergers set to no, but I have made an exception here, and instead I used a sell rule where days for merger annual is NA. There are different ways to do this. Basically, they do the same thing. But remember, if you have a universe rule that excludes mergers, if it's only in your universe, and it's not in your sell rule or in the periods and restrictions, then this option, then this is a good option to click no, because it'll sell stocks that have entertained a merger offer. Now, examining simulation results. Let's look at the summary tab first. Hold on. Let's go. Wait a minute. I do not want to rerun. I will go back. Okay, so this is the summary tab here. And there are a lot of things to check. Look at your active return. Is it positive? Obviously, this one's very positive, but that's a good thing to look at. Is your annual turnover what you expect? This has 1,000% annual turnover, which is super high, and I would not recommend a strategy that does this. But you know, I've seen strategies that have 12,000% annual turnover. So basically that means 100% annual turnover means that you're turning over your portfolio once per year. 1,000% means you're turning it over 10 times a year. Do you have a lot of cash on hand at the end of your simulation? Here I have negative cash because I'm using leverage. Is the number of positions what you expect? This is only 14 positions. Maybe I should run a simulation that has more. Take a look at the charts tab next. And this is a great little tool. The interactive charts are really great because you can focus in on certain periods. And when you hover over it, you can see all the different things. So, for example, here, I can look at the number of positions and I can see how they varied. And so they're staying around 12 to 15%. I mean, 12 to 15 positions, 10 to 15 positions, which is fine. Here I can see the leverage. The leverage is going up a little higher than I want it to. I don't really want to have, 31% leverage. And so I might need to fiddle with my settings there. And then the return is great because I can toggle log scale. I can see, okay, so this outperformed during this period, but from here to here, it did not outperform. It's great to toggle log scale, which you can't do in the screens, I don't think. So these kinds of charts are very helpful. The statistics page gives you a lot of great information. Returns, the monthly performance. I love this calendar year thing. This is a good simulation because it beat the benchmark every year except in 2018. Probably totally unreal. The trading tab gives you some really good information. I love this average return per stock. Average days held is very useful. It looks like this simulation invests mostly in losing stocks, but the ones that win make up for all the losses because this number is under 50%. Risk measurements, if you're into this kind of thing, Sharpe ratio, Sortino, correlation, R squared, beta, alpha. I like to use the weekly ones, which are calculated slightly differently. And so this is my bottom line right here. So that's the kind of thing that you can get from these stats. Now, I also recommend looking at holdings. Look at the allocation. This seems like a pretty typical allocation for one of my simulations, but you might not want so many microcaps. This is a pretty good sector balance, I think. Actually, there's no tech stocks in here at all, and no healthcare either, which is unusual. The transactions tab is really great too. You can look at just stock transactions. This will exclude dividends, and then you can look at what kind of slippage fees you're paying for these various transactions. Realized transactions are sorted by the return, and sometimes they're worth examining. I mean, this stock, Jaguar Mining, was held for 8 days and made 91.7% and made $600,000. That's just absurd. There's no way that you would have been able to get in and out in 8 days and make that much money on a tiny little mining company like that. That's pretty unlikely. And even if it happened, it's not something you would have been able to repeat. But it's good to look at this stuff, right? These are the rebalancing percentages here, which are interesting to look at. If you sort, I'm sorry, let's go back to all. I'll show you that. Here's date by date, the kind of rebalancing things that you're going to look at. So one thing I like to look at is if I'm buying a new position, 6.22%, 6.71%, 7.28%, they're all ranked really high. And then are my new positions in other weeks about the same? Here I have a new position that's 9%, also ranked really high, and this slightly lower. But this isn't so bad. It's pretty even. I've run simulations where the new positions just vary and jump wildly. and I'm not, and so this stock clearly must have ranked number one because it got a 14% weight. When you look at the realized transactions, you can do what I did, and you can say, well, are some of these things odd, or some of these unrealistic? You can sort them by symbol, and you'll see, wait a minute, why am I buying and selling ABCD 18 over and over and over again on different years and different days? And some of them is just because it's rebalancing. But if you're doing too much of that, if you've got like 18 transactions for one stock, then you know that something is a little crazy. You could sort by days. You're never held, this transaction is, this simulation is never holding a stock more than a year. Is that what you want? Maybe it's not the most tax effective way to invest. And then let's see how many simulations are holding only for 8 days. I don't know why Jaguar was sold after 8 days, because we have a minimum. Oh, it's because of the formula weight. That's why. But here, I've got a lot of transactions occurring within the first 7 days, 8 days. That's really not what I want. So there's some things there that I might want to try and change and try and fix. Another way to sort is by percentage gain. So here, if I'm finding that one stock here, LNTH, keeps getting, is responsible for these huge gains here. And I know it because I was actually invested in LNTH back in 2016. And I remember how wild the price was. It was a 5-bagger for me, I think. And so you might want to exclude that, rerun the simulation without LNTH and without RVP, and see if your returns still hold up. So the next thing you can do, if you have especially if you have a simulation with rather long holding periods or infrequent rebalances, is you go to the gear symbol and you can run a rolling test. And so you could say your period might be like, I don't know, 5 years, and you might want to run it every month, and then you can change the date range. You can disable or enable transaction costs, and then when you run it, this is going to take a long time to run, so I'm not going to run it. But when you run it, you'll get something that looks like this. Let me show you a rolling test that I ran. I guess, I don't know, we can look at this one. Result charts. You get charts that look like this. There's a histogram, all these different charts, which are not as useful as the actual data, where the data shows you that you got this return, this bench, the annualized. I guess I was using one year period, so these aren't very different. And drawdown sharp at Sortino for each single run. And you can go down and you can export this into Excel, and you can fiddle with it, and it gives you a lot of information on the possible results of your simulation. Now, I want to, sorry, I skipped the PowerPoints because I'm so involved in Portfolio 1, 2, 3. I want to talk a little bit about sell-driven and buy-driven simulations. Our simulations are automatically sell-driven. In other words, you don't buy a stock until one is sold, at which point you buy the highest ranking stock you don't own. Now, that's with portfolio weight rebalancing. With formula weight rebalancing, you can change that a little bit, but they're still basically sell-driven. You cannot precisely simulate a buy-driven strategy in which you sell the lowest ranked stock only when you have a new stock to buy. But you can get somewhat close to this by using formula weight rebalancing, and these are the settings here. If you want a 20 stock portfolio and want it populated only by stocks that rank in the top 10, and when a new stock appears, you want to buy it and then sell the lowest ranked stock to keep your portfolio at 20 stocks, these are the settings here. This will have a few flaws. There'll be a little extra cash sometimes, and occasionally your portfolio size might exceed 20, but it comes pretty close. And I have made a public simulation that is a buy-driven simulation. It's called buy-driven sim. It didn't do very well because I just tested it for the last 3 years, but I just wanted to show you how it works. So you can copy these settings. This is the trading system here. And this is a public simulation, so you can put in your own ranking system and your own universes, and you can see how that works. But I'm just going to show you the charts here. As you can see, the cash invested it stays pretty close to 100%. Occasionally, it dips down to 85, and the number of positions starts at 10 and then climbs up to 20 and stays around 20, but occasionally it'll go up to 23. That's just because we don't have an extremely precise way of doing buy-driven simulations. But because the way I invest is buy-driven, I just thought it would be helpful to people to know that such a thing is possible. We have so many projects in development right now, and I've been wanting to implement buy-driven simulations for a few years now, but we just haven't been able to get around to it because it's pretty time consuming. I think that just about wraps things up. So don't forget that we have another webinar. Our next webinar is not on June 14th. It is 3 weeks from today. And don't forget to use this offer if you want to sign up for a trial or upgrade your membership. Oh, and if you want to access this buy-driven simulation in your account, you would go to research and then research search, and you would put my name in here, Yuval Taylor, and then the model name would be buy-driven sim, and you'd be able to find it. Okay. All right. Thanks for attending.